Bunge Global SA just dropped their Q2 2026 earnings, and if you are looking for a massive top-line explosion based strictly on the print, I mean, this is the quarter, net sales practically doubled year over year.
Yeah, it's really an incredible jump.
They posted $24.04 billion dollars. Just compare that to the $12.77 billion in Q2 of 2025.
Right, and that kind of revenue expansion, doesn't happen quietly, and it flowed aggressively down to the bottom line. Q2 GAAP diluted earnings per share hit 3.47, which is up from 2.61 a year ago.
Which is a solid beat.
It is, but the number you actually want to watch, like the one the market's really pricing in, is their adjusted EPS. That came in at 2.0 compared to just 1.31 last year.
We should probably pause on that for a second because agribusiness accounting throws a lot of retail investors off.
Oh, absolutely.
Like, why are we stripping out those GAAP numbers and focusing entirely on the adjusted 2.0?
Right, so it comes down to something called mark-to-market timing differences. In global agriculture, companies like Bunge, they're constantly using forward contracts.
Meaning they're locking in prices early.
Exactly. They're locking in prices to buy or sell massive quantities of grain months in advance. But accounting rules require them to constantly revalue those open contracts based on today's market price, even if the actual physical grain hasn't even changed hands yet.
So it's just paper math.
Exactly, it's paper math. That creates these massive phantom gains or losses on paper that completely distort the reality of the quarter. So adjusted EPS strips out all that paper noise so you can see the actual cash-generating power of the physical operations.
Which is exactly what management wants to highlight right now. I mean, they didn't just point to a strong quarter in the rearview mirror. They actually raised their full-year 2026 adjusted EPS guidance.
Yeah, they did.
They bumped it up to a range of 9.25 to 9.75. That is up from their previous target of 9.00 to 9.50. So for you, the investor looking at this print, the mission of this deep dive is to unpack the mechanics here. We really need to figure out exactly how Bunge executed this doubling of revenue, analyze the friction costs of their massive expansion, and test whether their balance sheet is, well, actually built to handle the global risks they're navigating.
And I think the immediate question with a revenue jump from $12 billion to $24 billion is just, where is it coming from?
Right.
Because you don't get that just from tweaking efficiencies. You get that from moving unprecedented volume. And for Bunge this quarter, the sheer force of that volume came from their processing and refining segments.
Let's look at that breakdown, actually. I see soybean processing and refining as a major contributor here. Adjusted earnings before interest and taxes EBIT jumped to $445 million.
Yeah.
That is a pretty significant climb from the $304 million they posted in the exact same quarter last year.
Well, soybeans are really the foundational heavyweight of Bunge's entire operation, right? I mean, they processed over 11.5 million metric tons of soybeans this quarter. That is up from 9.3 million last year.
Yeah.
But what you really have to look at is how they pull different geographic levers to actually hit that 445 million figure.
I noticed that in the report, they highlight strong processing performance in the U.S., but refining results in North America were actually down. So where did the overall beat actually come from?
Right, so the geographic offset came from South America. They saw major improvements in Argentina's processing and refining, alongside stronger processing numbers in Brazil.
Interesting.
And this highlights a core mechanism of global agribusiness, which is that margin capture is highly regional.
Okay, break that down for me.
Yeah. So if crush margins, and that's just the profit you make from crushing raw soybeans into meal and oil, if those margins tighten in North America because raw bean prices spike locally, Bunge just leans harder on its South American footprint, where, say, the harvest might be pushing raw input prices down.
That makes total sense for the baseline business. But frankly, a jump from $304 million to $445 million in soybeans, I mean, that's steady growth. It doesn't explain the overall company doubling its net sales.
No, it doesn't.
The real anomaly in this report is the softseed processing and refining segment. Adjusted EBIT for softseed hit $255 million this quarter.
Which is just staggering when you consider the exact same segment generated just $14 million a year ago.
Yeah, that's like finding a hidden gear in a race car. I mean, going from $14 million to $255 million in a mature industry is wild.
It really is.
And just to clarify, soft seeds, we're talking about canola, rapeseed, sunflower seeds, What actually caused this explosion? Like, is this just a case of commodity prices suddenly swinging in their favor, or is this a structural change in how much product Bunge can actually push out the door?
It's really a combination of both, but you have to understand the mechanics of that crush margin we talked about to see why the operational expansion was the real multiplier here. The report credits a, quote, more favorable market environment.
Right.
But what that actually means is the global demand for softseed outputs like canola oil for renewable diesel or sunflower oil for cooking, it vastly outpaced the cost of the raw seeds. The spread widened.
Got it.
So the profit potential per ton was massive.
But wait, every agribusiness player sees that same spread, right?
Yeah.
Why did Bunge capture so much of it?
Because you only capture that margin if you have the physical, industrial capacity to take the raw seed, run it through a processing facility, and output the oil.
Ah, okay.
And Bunge significantly expanded their capacity. They didn't just have a good pricing environment, they were able to shove vastly more product through their system. Softseeds process jumped from 1.9 million metric tons last year to nearly 3.5 million this quarter.
So they essentially doubled the pipe right as the water pressure spiked.
Exactly. Perfect way to put it. You see this in their footprint expansion. They ramped up production capacity in Argentina, Canada, and Europe. In Europe specifically, that stronger processing capacity more than offset lower refining and biodiesel performance in the region.
Right.
And they also expanded their global origination footprint, meaning they built a wider network of grain elevators and local buyers to actually source those 3.5 million tons of raw materials from farmers in the first place.
Yeah, and you don't just double your processing volume and originate millions of extra tons of crop overnight by accident.
Definitely not.
Building that kind of infrastructure takes years, which points directly to the elephant in the room, the integration of Viterra. That transaction closed back in July 2025, and it essentially combined two of the biggest agricultural players on the planet.
Yeah, it fundamentally altered their scale. Viterra brought this incredible origination network, especially in regions where Bunge was historically a bit lighter, like Australia and parts of Europe. It fed directly into that soft seed explosion we just discussed.
But I want to push back here for a second, because acquiring a massive global network comes with a massive corporate hangover.
It does.
Let's look at the corporate and other segment. Adjusted EBIT, there was a loss of $131 million. That loss widened heavily from the $80 million loss they took year over year.
Right.
And the report explicitly admits this increase in corporate expenses is driven by the addition of Viterra and performance-based compensation.
Well, integration at this scale is incredibly expensive and complex. You are merging entirely different IT systems, you're consolidating redundant supply chain logistics, restructuring global teams. It adds up.
And furthermore, Q2 saw $32 million in net income loss, specifically categorized as acquisition and integration costs.
Yeah.
So if I am reviewing this as a retail investor, I have to ask, is this acquisition actually creating value, or is this $131 million corporate loss just a massive margin drag that is going to bleed cash for the next 3 years?
It's the defining question for any mega merger, honestly. To figure out if it is a margin drag or just a temporary friction cost, you have to stop looking at the isolated corporate expense line and zoom out to the cash generation of the entire merged platform.
Okay.
We need to look at adjusted funds from operation or adjusted FFO.
Why FFO instead of just looking at net income?
Because in a business that holds billions of dollars of physical grain, net income gets heavily distorted by working capital changes. Like, if Bunge buys a mountain of wheat right before the quarter ends, their cash flow looks terrible on paper, even though they hold a highly valuable asset.
Right, that makes sense.
So adjusted FFO strips out those seasonal inventory swings and gives you the clearest picture of the underlying cash engine.
And what does that cash engine look like post-Viterra?
It's massive. For the first 6 months of 2026, year-to-date adjusted FFO is $1.29 billion. That is nearly double the $693 million they generated in the same period last year.
Wow. That puts the $32 million integration costs into a very different perspective. They're spending millions to stitch the companies together, but the combined entity is throwing off an extra $500 million in cash flow.
Exactly. That is the math management is relying on. And they are proving their confidence in that ongoing cash generation through their capital allocation. Despite carrying all these integration costs, Bunge repurchased roughly $250 million in shares during the quarter.
And that isn't just some routine baseline buyback either. They announced they successfully completed the $2 billion share repurchase program that was specifically designed to offset the dilution of the Viterra transaction.
Which is a massive signal to the market. It proves they have digested the major financial obligations of the deal. I mean, they are absorbing the corporate overhead, finalizing the integration, and still generating enough surplus cash to aggressively return value to shareholders without starving their actual operations of capital.
I want to pivot to those actual operations because generating 1.29 billion in FFO requires holding and moving a staggering amount of physical inventory.
Oh, yeah.
And holding that inventory requires debt. If we look at the balance sheet, the gross debt sits at 15.2 billion.
Right.
For someone used to analyzing tech companies or retail stocks, seeing a 15.2 billion debt load against 24 billion in quarterly sales might trigger some serious alarm bells regarding leverage.
It definitely would.
Yeah.
But if you look at an agribusiness balance sheet through a traditional corporate lens, you will misprice the risk entirely. You cannot treat their debt the way you would treat debt held by, say, a software company.
Okay.
We have to break down what that 15.2 billion is actually financing.
And the report points heavily to RMI for that.
Right. Readily marketable inventory. Of that 15.2 billion gross debt, the vast majority is financing RMI, which currently sits at 13.3 billion.
You know, I like to think of RMI as holding a wallet full of gold coins rather than having a 30-year mortgage on a factory.
Okay, I like that.
Because if a company has a mortgage on a factory, they have debt, sure, but they can't quickly sell a single assembly line to pay a surprise bill tomorrow. It is an illiquid asset.
Exactly.
But if a company takes out a loan to buy a wallet full of gold coins, they can sell those coins instantly on a global market if they suddenly need to clear the debt. The underlying asset is highly liquid.
That analogy perfectly captures the mechanics of agricultural commodities.
Hmm.
RMI consists of millions of tons of soybeans, canola, wheat. These are highly standardized global staples.
Right.
Like a metric ton of number 2 yellow corn is the same everywhere, and it trades on a massively liquid global futures market. Bunge isn't holding obscure, half-finished consumer electronics that might go out of style in some warehouse. They are holding raw calories.
So how does the broader financial system view that? Like, do the credit rating agencies penalize them for holding 15 billion in debt, even if 13 billion of it is tied to raw calories?
No, they recognize the liquidity. Credit rating agencies typically apply a credit, usually around 70%, against that inventory when they calculate the company's leverage.
Interesting.
Yeah, they acknowledge that in a worst-case scenario, Bunge could basically dump that inventory onto the global market almost instantly to pay down the debt. Because of this dynamic, Bunge reports an adjusted net debt figure that paints a much more accurate picture of their real obligations.
And when you factor in the RMI and the cash on hand, that adjusted net debt number drops drastically. It falls to 6.7 billion.
Which brings their adjusted leverage ratio to 1.9x. And for a company operating physical infrastructure on every major continent, a 1.9x leverage ratio is a fortress.
Yeah.
It provides the financial elasticity they need to weather unexpected market shocks, or, honestly, more importantly, to capitalize when those shocks hit their competitors.
It is a good reminder that we are analyzing a massive logistical operation, not just a financial holding company. And you see the physical reality of the business in their grain merchandising and milling segment as well.
Definitely.
That division posted an adjusted EBIT of 67 million, which is up from 29 million. And the report notes that jump was driven by ocean freight and wheat milling. Like, they are chartering massive vessels and moving thousands of tons of grain across the ocean daily.
And that physical exposure, putting ships on the water, relying on river levels, dealing with global ports, that brings us to the ultimate risk profile of the company. A fortress balance sheet is great, but it is built to protect the company from real-world threats.
Which brings us to the forward-looking risks. We know the growth engines in softseed and soybean are firing.
Right.
We know the Viterra integration is generating cash despite the friction costs. We know the balance sheet is highly liquid. But what breaks this machine, management has to be watching something.
Yeah, and if you read CEO Greg Heckman's commentary, the tone is surprisingly cautious despite the massive beat.
Right, he doesn't sound like he's doing a victory lap.
Not at all. He explicitly mentions navigating a, quote, complex global environment, relying on agility, focus, and disciplined execution.
Yeah.
He specifically credits the newly expanded global platform for allowing them to capture opportunities amid shifting trade flows and geopolitical uncertainty.
And shifting trade flows is usually corporate code for tariffs and embargoes, right?
Usually, yeah.
When you read the cautionary statements buried in the release, they are highly specific. They call out the ongoing war in Ukraine, changing agricultural and trade policies, extreme weather conditions, and crop or animal diseases.
Which forces us to evaluate how we analyze risk in this specific sector. In almost any other industry, geopolitical conflict and severe weather are absolute headwinds.
Oh, yeah.
If a hurricane shuts down a region or a tariff blocks a port, a standard manufacturer just loses revenue.
Hmm.
But if you connect the macro environment to Bunge's actual performance, you realize something totally counterintuitive.
What's that?
Their guidance raise across all these segments is happening during this period of immense geopolitical and climate volatility.
So you're saying they aren't just surviving a complex environment, they're structurally designed to profit from it. Like, how does a drought or a blocked port turn into an EPS raise?
It comes down to the mechanics of arbitrage at a massive scale. Volatility creates mispricing. If a severe drought hits the Black Sea region, the global supply of sunflower oil plummets, and prices in Europe spike.
Oh, supply and demand.
Exactly. Smaller regional grain processors in Europe are paralyzed because they can't source the raw seed locally. But Bunge, utilizing that massive Viterra footprint we talked about, has the optionality to source canola from Canada instead, crush it in a North American facility, and route the ocean freight to Europe to fill the supply gap at a premium margin.
So they have the scale to step in when the regional players fail.
Exactly. When Heckman says the platform did what it was designed to do, he means it absorbed a supply chain shock that crippled competitors and used its global logistics network to capitalize on the resulting price disparities.
Fascinating.
They don't need perfect weather globally, they just need the logistical flexibility to pivot away from the bad weather and route product from where it's abundant to where it is scarce.
That completely inverts how a retail investor should view their risk profile. I mean, you aren't just analyzing their exposure to a specific bad crop yield. You are analyzing their ability to profit when things go wrong somewhere else in the world.
And this leaves us with a critical framework for analyzing mega agribusinesses moving forward. We are operating in an era defined by deglobalization, persistent geopolitical friction, and highly unpredictable climate events. Companies like Bunge at this specific scale are no longer just food processors.
What are they then?
Armed with immense balance sheets, global logistical networks, and real-time data visibility across thousands of local farming markets, they essentially function as macroeconomic hedge funds.
But instead of trading paper derivatives, they are trading physical ships of soybeans and soft seeds.
Exactly.
They use global supply chain volatility as their primary mechanism to drive returns. It is just a fascinating way to view the commodities that end up on your table. We're going to leave the analysis there for today. If you want to keep cutting through the corporate filler and understanding the actual mechanics behind these earnings reports, make sure you follow the show for our daily, no-nonsense earnings coverage. See you next time.